Welcome to Solidarity Spotlight, the place where we share with you bleeding-edge stories in blockchain development. I'm your host, Solidarity. Today, we dive into 6 pivotal stories shaping the blockchain landscape, from institutional Bitcoin acquisitions and Ethereum's transformative upgrades to regulatory shifts and security challenges. Each segment unpacks the context, latest developments, and broader implications, painting a holistic picture of this dynamic ecosystem. Let's begin with a major move in corporate Bitcoin adoption. Japanese investment firm Metaplanet has executed its third largest Bitcoin purchase, acquiring $132 million worth of BTC. This marks a strategic continuation of its treasury diversification strategy, following earlier acquisitions that positioned Bitcoin as a reserve asset comparable to gold. The purchase of 1,234 BTC at an average price of $108,129 per token coincides with similar moves by institutions like Bakkt, which announced a $1 billion Bitcoin treasury plan. Such institutional adoption signals growing confidence in Bitcoin's long-term value proposition, particularly as a hedge against fiat currency volatility and inflation. Analysts note this trend may accelerate as public companies seek alternatives to traditional reserves amid global economic uncertainty. The scale of these acquisitions underscores a maturation in crypto investment strategies, moving beyond speculative trading towards structured treasury management. Turning to Ethereum, the long-anticipated Pectra upgrade is set to launch, merging the Prog and Electra enhancements into a single hard fork. This upgrade targets critical scalability limitations by doubling Layer 2 blob capacity, a move that could reduce transaction costs and latency across decentralized applications. Equally significant is the introduction of account abstraction, allowing users to pay gas fees in stablecoins like USDC rather than exclusively in ETH. This innovation lowers entry barriers for non-technical users and could spur DeFi adoption. Equally transformative is the increase in validator staking limits from 32 ETH to 2,048 ETH, enabling institutional participants to engage more efficiently with Ethereum's proof-of-stake consensus. Historical data suggests such upgrades often precede increased developer activity and TVL growth in DeFi protocols, as seen after the merge. Regulatory developments are intensifying in the US, where new rules now mandate crypto exchanges to register with federal agencies and implement stringent identity verification protocols. These measures specifically target anti-money laundering compliance and consumer protection, requiring platforms to disclose fee structures and manage conflicts of interest transparently. Notably, the SEC has differentiated between asset types. USD-backed stablecoins meeting reserve requirements aren't classified as securities, while meme tokens face fewer restrictions if devoid of investment contracts. Concurrently, the Haggerty Bill proposes 100% liquid asset backing for stablecoins, aiming to prevent destabilizing reserve shortfalls. This bifurcated approach reflects regulators' struggle to balance innovation with risk mitigation, potentially accelerating market consolidation as smaller exchanges struggle with compliance costs. Security remains a pressing concern, exemplified by the $9.6 million exploit of the resupply protocol. Attackers manipulated interest rates within the protocol's controller contract, exploiting a floor division flaw to borrow ReUSD stablecoins with near zero collateral. The stolen funds were laundered through Tornado Cash, highlighting persistent vulnerabilities in DeFi's composable infrastructure. This incident follows a pattern of attacks targeting low liquidity markets, where price manipulation enables large-scale theft. Blockchain forensic firm Slowmist emphasized that such exploits underscore the need for enhanced contract auditing and real-time monitoring tools. The breach has already impacted investor confidence, with resupply's TVL dropping sharply, a reminder that security infrastructure must evolve alongside financial innovation. Russia's digital ruble rollout has been delayed until September 2026, shifting from the initial July 2025 deadline. The phased implementation will require systemically important banks like Sberbank and VTB to support CBDC transactions by 2026, with smaller institutions given until 2028. Merchants face tiered compliance based on revenue thresholds, starting with firms exceeding 120 million rubles annually. The delay stems from technical integration challenges and the development of a universal QR payment system by the National Payment Card System. Politically, the digital ruble aims to circumvent Western sanctions by facilitating BRICS trade settlements. Though public adoption hurdles persist, surveys show 63% of Russians lack awareness of the CBDC's purpose, complicating uptake efforts. Finally, the EU's MiCA regulations are entering a critical enforcement phase. Crypto asset service providers must now restrict services for non-compliant stablecoins, with full CASP licensing required by June 2026. The regulations integrate stringent travel rule protocols, mandating sender-receiver data collection for all transactions, a measure targeting money laundering, but increasing operational complexity. Market consolidation is accelerating as compliance costs squeeze smaller firms. Binance's exit from the Netherlands and Cyprus exemplifies this trend. Analysts anticipate these rules will enhance institutional participation, but may stifle niche innovation, reshaping Europe's crypto landscape into a more standardized but less diverse ecosystem. That concludes today's Spotlight. I would love to know your thoughts. Thanks for listening, and don't forget to follow me for more spotlights. See you next time.